Got it.
All right. All right. So we've got Jon Traynor here from the Field Group. How you doing, John?
Good, Anthony. Yourself?
Yeah, good, mate. Good. Maybe just tell the listeners a little bit about yourself and your company.
Yeah, so the Field Group, we're an accounting practice out in Chernside Park in Melbourne. We've been around since the 50s. If you came in my office, you'd see a big caravan on the wall. The firm started in the 50s with an accountant traveling around country Victoria, doing tax returns for farmers out of his caravan. We've progressed from there. We've got 40 accountants here. We all work in the, on Surface Pros in the cloud, utilizing, I guess, the latest technology.
Awesome, awesome. And you're based out in Victoria, in Melbourne, Victoria, out in Chernside Park, correct?
That's it.
Excellent, excellent. And you forget to tell these people that you're a mad Security supporter too, right?
I am. So if we're at my home office, you'd see Nicky Winmar and Robert Harvey posters hanging behind me. But today we're in Chernside Park, so you get Maroondah Highway there in
Beautiful,
the background.
beautiful. All right, John, thanks for joining us, mate. Listen, what we wanted to do is just again share information and education with our clients and our listeners. It's coming up for tax time, June 30. So, what better person to speak to than yourself, mate, regarding how to real estate investors more so, what do they need to remember, be aware of when it comes to tax time?
Yep. So I guess the first thing to remember in FY23, so financial year 23, is that your refund's actually going to be less. So the government had some changes last year where they cut the low and middle income tax offset.
Yeah,
So what that means is for any taxpayer who earns less than $126,000, you're going to miss out on up to a $1,500 offset that you actually got last year. So your refund's actually going to be lighter because those measures were temporary through COVID.
yeah,
So I guess message one is the government's trying to get into your refund before you even start making any claims.
yeah,
Now, from there, I guess real estate clients, the number one thing is that depreciation schedule.
yeah.
So depreciation schedule allows you to claim essentially the purchase price of your property.
Mhm.
And what it does is it differentiates the land and building cost within that purchase and allows you to claim the building cost over what essentially becomes 40 years. So there's some assets which have got faster lives,
Yeah,
but essentially it's your building cost. So your bricks
yeah,
get depreciated over 40 years,
mhm,
and that really helps you come tax time.
yeah,
Now, if you've had your property for a number of years, that report may be something you've already got. If you haven't, I think you guys have a relationship through Wealth for Life for the quantity surveyors business. But roughly $700, that's a tax deductible expense.
yeah.
You get that report and it'll allow you to claim the depreciation on your property each tax year.
Excellent. And that's so they do the building write-off, as you mentioned, and then also the fixtures and fittings, correct?
Correct. So yeah, so there'll be your bricks, your timber, all the structural items of the property, generally depreciated over 40 years.
Yeah.
And then they'll be looking at items like the dishwasher, blinds, carpet that will not last 40 years. They have a faster effective life, which means you're able to depreciate them quicker
Yeah.
and increase your claims.
Fantastic. So in addition to depreciation, John, what should real estate investors be mindful of come tax time? Because, there's a lot of investors that really leave money on the table they don't get to claim, or they're not even aware of some of the items that they can claim as investors. So maybe cover some of that off, John.
Yeah, so if you jump on our website, fieldgroup.com.au, I think click up top right, there'll be checklists, and there'll be one there for real estate clients. And what it'll have in there is it'll have that depreciation schedule,
Yeah.
interest on the investment loan. So that's a big one. Any repairs, council rates,
Yeah.
land tax,
Yeah.
water rates, any costs that you have in relation to that property
Yeah.
will be tax deductible.
Yeah. So what about people, John, that have purchased property recently? Can they claim things like stamp duty, holding costs, a lot of those one-off costs, right, at settlement?
Yeah, so unfortunately, no. So those costs become part of the cost of acquiring that property. So those costs, you can still claim them, but you claim them when you sell the property. So they form part of your cost base, which allow you to reduce any capital gain on that property when you sell it in 15, 20 years' time.
Yeah. Okay. Excellent. Excellent. So things like land tax are still claimable, um, and your standard depreciation, interest on the mortgage, and then
Yeah,
you.
correct. So land tax is a funny one, isn't it? So it's something you pay the state government, and you're allowed to claim it and reduce the tax you pay the federal government. Um, that's been a topical one, I guess, in the last 3, 4 weeks with the Victorian state budget dropping and those rates obviously going up next year. In terms of what on average, what do they go up? Well, it's going to depend on the land value of your property, but what we're seeing is a lot of investors that are holding, let's say, units that have previously had a really low land value are all of a sudden going to get caught in these land tax changes. So that's not great for them. You know, it could be a $500 bill that they're going to receive next year that they haven't received before. The good news is that is tax deductible, though.
Fantastic. And what do you see a lot of investors doing, John, with the expenses going up, such as land tax? How do you see, or what do you recommend a lot of investors do to counteract that?
Increase your rent. Don't feel bad. Pass on those costs. It's not what the government wants to hear.
Yeah.
But I guess, step one is making sure that your tenant is paying the market rent for your property and making sure that when you're hitting those reviews that the client or your landlord, your tenant is paying the correct rent. Beyond that, by way of expenditure, we want to keep good records to make sure we're not missing out on any deductions.
That's that is such a good point, because I think a lot of real estate investors sometimes tend to not keep the best records when it comes to their expenses along the way.
Yep.
Yeah.
So there's a number of tools online which you can use, but I think an Excel spreadsheet is as good as any. So yeah, if you get a lot of your invoices emailed to you, I know for me, if you can just save them in a folder throughout the year that relates to your property, it's something you can pretty quickly summarize at the end of the year or forward those emails to your accountant advisor to collate to put into your tax return. And then, you can jump on our line, use our checklist, and that'll give you that reminder to say, hey, have I picked up all of the standard costs that you would see with an investment property?
Yeah. Fair enough. And maybe talk about some of the changes that the ATO has brought in or about to bring in that may affect investors. I mean, land tax is one of them, obviously, that kicks in on the 1st of January in 2024. I mean, we did some information on that not long ago. But anything else, John, that investors should be aware of?
Look, the land tax one is the one that's made the media, in Victoria the most, and I'm not really across the changes to other states and what they've done with their land tax. But I think it's important to note that land tax is a state tax. So if you're an investor, potentially having all of your properties in the one state is going to mean you're going to be liable for a higher land tax bill than if you'd spread your portfolio, let's say, throughout Australia, where you would be picking up those land tax thresholds in each state, because generally those land tax thresholds don't take into account your land holdings in other states.
Yeah, got it. It's interesting because it's feel like Victoria's copped the brunt of it all with regards to land tax. So we dealing with a lot of our landlords, obviously on a daily basis, you can sense their frustration, and they're all looking at when their leases expire and what they can do to actually raise their rents. And I mean, that's the other thing too. You need a really good property manager, one that's sharp and proactive, and can understand the market. Because we find more than anything when we have landlords that come to us that have been using other property managers, we find their rents are so below market value where the property manager hasn't done a lot to raise the rents.
100%. And that's the, I guess, going into our land tax increases, that's just part of being the state we were locked down for so long, the stimulus that the government released to see us through that. And unfortunately, the cost of that's starting to bear fruit now.
Yeah, yeah. And if you're not a real estate investor, let's say you're a business owner, John, what do they have to look forward to leading up to June 30?
Yeah, so I guess the biggest one leading up to 30th of June is the instant asset write-off. So currently you can buy any asset in relation to your business as long as your business turnover is less than $5 billion. If you purchase that item and have it installed ready for use before the 30th of June, you'll be able to claim a tax deduction for that acquisition. So be it, plant and equipment, a big excavator, a motor vehicle up to 57,000, computers, any plant and equipment. And there's no limit on it as long as your business is under $5 billion, which I'm assuming is going to be everyone on this Zoom.
Is that 5
your
million?
business will be able to claim
5 million or
5 billion.
Billion. Yeah.
5 billion. So we're going to be all in. Now, the challenge with that is actually finding plant and equipment before 30 June. So there's so many supply chain issues like today, this call, early June 2023, you've essentially got 3-4 weeks to go and find that plant and equipment and have it installed ready for use by 30th of June. But if you can do that, you will get a full tax write-off for that asset in the current financial year.
Yeah.
If you buy that asset in the next financial year, for you to get an instant asset write-off, the asset must be less than $20,000.
Got it.
So big change. We've got this unlimited limit now.
Yeah.
It's going to reduce to $20,000 if your business is turning over less than $10 million.
Yeah.
If your business is turning over more than $10 million, that limit is reduced to $300.
Yeah.
So you've got those businesses that have now got an unlimited limit. Getting reduced to $300 is really going to, I guess, slow purchases for those small businesses in Australia.
Yeah. It's interesting. Like you bring up a good point. Like, if you're a business owner, because you have more flexibility as a business owner, what kind of planning should they be doing? Because you're right. You don't want to be starting to look at making decisions like this in June. Like, what kind of planning throughout the year would a business owner do, and how often should they be talking to their advisors, such as yourself?
Yeah, so I guess there's a few different ways to answer that. I guess the first thing to note is what are your goals as a business and as an individual. So paying no tax is great. Minimizing your income so you pay no tax is great. However, it can come at a cost when you go to, let's say we go back to real estate and you want to lend.
Yeah.
If you don't have the income on those notice of assessments that get you through serviceability, that can be a problem. So, we're working with our clients to work out, hey, what are your goals? What are your plans over the next 2-3 years? When do you want to lend? And making sure that we're being able to demonstrate to the lender that we have the capacity to borrow what we need to borrow.
Yeah, you're spot on, John. Like so many business owners, even contractors that are not on PAYG, right? Salaries, they come to us and, they're showing $34,000, $40,000 a year as an example, right? On their income statement. And we can't help them, with regards to a loan. So, and, we understand.
Yeah, and in a lot of cases, those businesses have had great income, right? So they've earned 150,000. They've bought 2 cars in that financial year. They've taken advantage of this instant asset write-off, and their $150,000 income's down to $50,000, and they can't service a loan. And that leaves them dealing with me, writing letters to say, hey, this taxpayer has earned $150,000. Maybe we get them a loan, but it's at a much higher interest rate than what they would have got if we'd planned their affairs better.
And that's the key. Like, this is the advice we give to our not just business owners, but just clients in general. Like, don't wait to the end to get your stuff together, right? because you can't make a lot of moves as you just mentioned. In June, if you want to go out and get equipment installed, with all these supply chain issues going on right now, it's impossible to do that if you're deciding to do it in June. So the message out there is, do your planning in July. As a business owner, do your planning in July for the next financial year. So, get in front of your advisors on a much more regular basis and not just after the fact. Yeah. Okay, good, mate.
Correct.
And would there be anything else that you would suggest or recommend that investors, business owners should look at? Such things as self-managed super funds.
So a big one is just superannuation contributions. So assuming less than 75 years old, you can contribute up to 27,500 into your super each year. Now that 27,500 includes, if you're employed, what your employer has contributed already into your superannuation. But that's certainly a huge tool before 30 June to use to reduce your income. I guess the cost of doing that is you've got to have the cash. So you've got to have the cash to put into super, and you've got to be prepared to have that money locked up till 65. So you're not going to be able to contribute to super and pull that money out in 2-3 years' time. You need to leave that money in there for your retirement. But if you're in the fortunate position where you've got surplus cash, and we're looking for a quick way to reduce your income before 30th of June, superannuation's it. There are some rules around making catch-up contributions. So the cap at the moment is 27,500 per taxpayer that can contribute to super. If your balance is less than 500,000, you can make catch-up contributions. So you can put multiple years of unused super in. Where that works great for investors is generally when they're selling a property. So if you sold a property, made a capital gain, and you will have received the cash from that transaction, that sale, contributing to super is a way to significantly reduce that capital gain.
That's fantastic, John. Brilliant advice. All right, John. Last question I'll ask you, mate, is what's the one thing, as an advisor, what's the one thing you see that investors tend not to claim or forget to claim?
So generally, it's that depreciation piece. So we will receive we'll be introduced to a client that maybe have held an investment property for 2-3 years. They'll come to us for the first time. We'll look through their tax return and realize they haven't been claiming depreciation on their property because they thought it was too old, or they didn't realize what that was. So getting that QS report, it's a $700 one-off cost. Get that in. We can then go back and claim from 2 years from when you've lodged your last tax return and amend those tax returns and get those refunds back for you. So the depreciation is number one. The next biggest claim is interest. So just making sure that you're claiming the maximum amount of interest that relates to your property. So that means making sure that you've got offset accounts for your investment property. If you're putting any excess cash in, you're not paying down that loan. You're not contaminating that loan by continuing to draw down on, let's say, available funds in that loan account, and then using that money for something personal and reducing the amount of deductible interest you can claim on that property. So I would say they're the two biggest claims, or the two biggest areas that you need to focus on to make sure you get the biggest return on your investment property from a tax perspective.
Fantastic, mate. Well, listen, we wanted to keep it short and sharp, so thank you very much, John, for sharing that information with us. And I'll say one thing, I've been working with John, been working with you, mate, now for quite a number of years. You look after a lot of our clients. I know they're super, super happy. I hope you don't mind us referring them your way.
No problem.
And if you're looking for anyone listening here, if you're looking for an accounting practice that walks the walk and talks the talk, and actually, are investors and business owners and are expanding and can think outside the box, strongly recommend you give the Field Group a call. What are you, John, at fieldgroup.com.au?
That's it. And you'll be able to, you can actually book an appointment straight from that website. So there's a link there that links to a calendar, and yeah, you can meet Zoom, phone call, face to face, whatever suits.
Good on you, mate. Now, as an AFL nut, mate, who's your money on this year for the big game, the big grand final? We can't have a conversation without talking about football, right?
That's it. Well, I'm a Saints man, and we're fifth, so I should be picking us. But look, I think the D's. I think
Yeah.
none of us want Collingwood to win, so probably Demons are next best. Haven't won at the G. They won one over in WA. So if it's not the Saints, I think the D's.
Mate, I had this wild premonition that Brisbane played Collingwood in the grand final. God, I hope that doesn't come true.
Yeah, we don't want that.
Yeah. All right, mate. Thank you so much for your time today, buddy. And thank you for sharing that information. And for anyone else that has any questions regarding this conversation, just hit us up at wealthforlife.com.au or reach out to the field group at fieldgroup.com.au. Thanks, John.
Thank you.
Yeah, mate.
See you, mate.